G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from the Alcove. G'day, Chris. How's your week been?
Oh, going well, Pete. Not much to report on here. It's kind of feel like we're in the trenches of getting into winter. First time I put my jumper on for an episode, but what did we do on the weekend? Had the kids' birthday party up in the sort of a nature play where they got to touch lizards and turtles, and that was actually quite fun. It was an interesting story, actually, Pete. I just checked on our 2 cents episode just as we were getting in the car to go to that birthday party, and you and I popped up on YouTube, and there's my daughter, who I don't know how, but she goes, "Oh, there's Pete." So even my daughter recognizes you, Pete. So you are very famous. But what else is happening here? Up in Newcastle to see my mum this weekend. So if you're listening to this right now on Sunday, I'm probably down Merriweather Beach having a coffee, hopefully enjoying a sunrise down there. But what's news in your world, mate?
Yeah, well, football mainly. So the AFL season's underway. So I just can't keep the kids away. You know, we're down the beach every day, kicking the sherrin around, and then every other available night we're watching football or going to Suncorp and the Gabba. It's just non-stop here. But yes, I think for Queensland, following on from the cyclone, we've had more pretty brutal weather. There's been an extraordinary amount of rain across the state and more flooding in some areas. So, that's been a pain, but it seems to be gradually righting itself. And I think, as you said, I mean, it's jumper weather down south, which means we're heading into a cooler time of year for the property market as well. I think we had a really big auction weekend just gone, but probably that's the last one for the year now. And then usually what you start to see happen around this time of year is there's fewer people listing, there's fewer auctions, and the supply just starts to tighten up a little bit because the spring and summer selling season has been and gone. So, yeah, I guess the property market has been fairly steady, really, in the face of that extra supply. But we've had one interest rate cut in the cycle. There's a couple more priced in for the remainder of the year. So I guess a bit less supply probably over the next few months. But obviously, it was the RBA decision this week. Did you get to watch the presser?
It's funny. I was on a client call at 2:30, and I was got to about 2:50 or something on the call, and I was like, "Oh, yeah." I was talking about the RBA, and I was like, "Oh, actually, it was today. It was meant to be at 2:30. I don't even know the result." Usually, I've got about 100 emails, and everyone on LinkedIn thinks it's a good idea to tell everyone that it was a hold in interest rates. But a bit of a non-affair. But I mean, the likelihood of a rate cut, the next one's pretty high, right, Pete? And or the next one after that. So the expectation of rate cuts, but I mean, it's a pretty unsure of, how many cuts they're going to be. And I think that expectation of how many cuts are coming is the thing that's driving the market the most. It's an interesting time of year, right? I mean, I think even the next week or 2 weeks or 3 weeks, people are going to be like, "Oh, there's just no listings. Oh, there's no listings because of Easter and Anzac." And, agents want to run a really, keep the campaign really hot. So the last thing they want to do is list prior to a school holidays, and then they lose momentum. And every agent's a little bit nervous, like every vendor. So, I mean, you got to be quite brave to list it in May, because by the time June comes around, it starts to get a bit cold. And not every property shows its best colors in the colder months. They need, say, the summer months to, let's say it's a south-facing block, etc. People really want to sell them at certain times of the year, but some properties really still look good in winter. So, I mean, that's what you usually find, P. What do you usually see at this time of year?
Yes, it is usually like that. I mean, particularly so in Sydney and Melbourne, the two big auction markets. Maybe in Brisbane, not so many properties sell at auction. There's a lot more private treaty sales, but still, as you said, Easter's a big disruption. Anzac Day and the weekend then, and a lot of parents are busy with the kids and things like that. So there's typically fewer listings that would come on as you get into April, May, June. So yeah, I think, and chatting to clients, I mean, a lot of people are phoning up and say, well, what's going to happen to my borrowing capacity? What's going to happen to my mortgage rates? I think the thing that the sort of general macro picture is, obviously tariff war is creating uncertainty. I think the RBA in its release put the word uncertain or uncertainty in at least a few times, if not half a dozen times, which, I mean, you could say that's a bit of a cop-out, right? Because the future is always uncertain to some degree. But I mean, I think Michelle Bullock made the point in her press conference that I mean, Australia's been a major beneficiary from free trade around the world. And if that starts to tighten up and globalization starts to reverse, that's not really good for our economy. So therefore, I mean, that's probably why bond yields have slipped quite a bit over recent weeks, and why interest rates are expected to fall. I suppose the unknown is what happens if tariffs start to raise prices. Doesn't mean that inflation necessarily gets embedded, but you could see a one-off step change or change in the level of prices. So I think those are the uncertainties that nobody really knows how things are going to play out. But it just seems that the one interest rate cut in the cycle, well, it's probably not enough to get a party started in the housing market because people are still paying 6% or more on their mortgages. But I saw your old mate Chris Joy lead article in the Fin last Friday, I think, just talking about the housing market starting to turn around and gather some steam.
Yeah, I mean, Chris Joy's not a guy you probably want to get into a discussion with, because I think he'll belch you with all his knowledge in his brain. But he's been pretty quiet on property. And I think a lot of that, and he did say this in his article, which hats off to you, Chris. But I mean, he basically showed that he didn't really call the downturn and the resilience in the property market when it bounced back. He sort of said that sort of surprised him, which, you're always going to get it wrong at some point, but he has got it right a lot. And what he kind of showed is that no one really expected the bounce in population and how that population bounced back post-COVID really impacted the property market because it caused a rental crisis. It caused a lot of housing shortage in terms of listings, a lot of more demand, people buying, etc. And so I think that's the thing that he found. He kind of pointed out that he got surprised by, but he also sort of highlights that as we've flipped over, there's a bit of a recovery coming in terms of prices. And Chris has called it pretty much year on year, all the way back to 2008-9, I believe. And so he's sort of showing that, well, actually, maybe the market's turned back on an upswing. And as soon as that first rate cut happened, you could see a change in terms of prices. I mean, on top of that, I mean, the coalition. I mean, I thought you sent me this headline, Pete. I mean, I was like, well, the coalition don't decide what APRA do. APRA decides what APRA does, but the coalition basically said that they're going to try to reduce the buffer from 3% to 2.5%. The assessment rate buffer on home loans, which will increase borrowing capacities for borrowers. And that's their argument, right? That, borrowing capacity is so tight for first-time buyers in particular. We need to give them more money because they're getting pushed out of the market. The irony is if you give them more money, prices will rise pretty quickly in correlation to that. So what was your take on that? The government kind of saying that they're going to reduce the buffer.
Yeah, so I'll just quote from Chris's article here. So since mid-February, dwelling prices in Sydney and Melbourne have appreciated by 0.7% and 0.9% respectively, with a clear turning point identifiable in the CoreLogic hedonic index data. So basically, the first interest rate cut has turned around the market already. And fair play to CoreLogic, because they actually did note that the falling interest rates would benefit the most expensive markets. So look, markets are pricing in, as Chris points out in the article, about two and a half more rate cuts this year. And as you said, at the moment, we've got this 3 percentage points lending assessment buffer in place, which is to protect people from rising interest rates, but at a time when the yield curve is inverted and interest rates are expected to fall. Now, a lot of people are clamoring and saying this is a disgrace, why erode lending standards. But you've got to remember, if you went back to pre-2014, the lending assessment buffer was 2 percentage points. Then it was increased to 2.5 percentage points before COVID or in the pre-pandemic period. In other countries, like the Bank of England uses a 1% buffer. I guess people seem to sort of coalesce around this idea that if interest rates go up by a certain amount, then suddenly magically everybody defaults. But it's not really how it works. It's more of a stress test. And usually you only see interest rates going up when incomes are going up as well and the economy's strong. I think when you try to put numbers on it, I think Canstar did some analysis and said, well, for an average or typical borrower, if you cut the lending assessment buffer from 3 percentage points to 2.5, then it might add 20K to your borrowing capacity. And if you went down to a 2% or 2 percentage points buffer, which isn't actually proposed, that would be 40K. So, yeah, I mean, to be honest, I was chatting to Tim Reardon, chief economist at the HIA, and I know they've been pretty vociferous on this, that really the point of regulation is not to reduce house prices. It's to maintain the financial stability of the system. And having a very wide buffer doesn't necessarily help at this point in the cycle. In fact, if anything, it's constraining supplies, completely locking out lower income earners. And over the long run, different systemic risks can build up that way with the housing shortage. So, yeah, I think APRA should move there anyway. But it sounds like the coalition might force the issue.
Yeah, we haven't even mentioned that. I think the election was announced between our episodes, Pete, as well, right? And that's another weekend that you wouldn't want to be doing your first open home on that weekend. So that's after the Anzac Day. So that really shows that, mid-May is when new properties are going to come on. I don't think there's going to be much coming on. A lot of people are going to probably can their decision to upgrade or investor to sell right now, and they're going to hold off selling for a few more months. So we're starting to get into a pretty dire position. If you're in the market looking to buy, there's very little going to come on for a few months. But I think that those numbers are on average loans. I mean, a good way to think about every 0.5% or 0.25, you can even think about it like that, is 5% is a 0.5% cut, or a 0.25% cut in the assessment rate would be a 2.5% increase in borrowing capacity. So, let's say on $1 million loan, then that's maybe an extra 50 grand for borrowers, let alone there might be one or two rate cuts. There's already been one. That's maybe another 50 grand. And so you can see why borrowing capacity can very quickly get factored into prices, because every single borrower right now is spending every dollar. Like, that's just the reality. And they're also going to the bank of mum and dad to get extra money for a deposit. But I think, that would be my take. Is there's another pressure, right? If you can increase borrowing capacity, particularly for first-time buyers, that's really going to support, say, the construction industry, because borrowers can't borrow enough to make developments more feasible. And then also the greenfield estates, particularly where a lot of first home buyers borrow, they also need first home buyers to have bigger borrowing capacity, because then that allows them to be able to sell more land and sell more house and land packages, etc. So, and the government really wants that as well. They make a lot of money on those developments. So, you can see where the incentives are aligned to.
Yeah, and you could say actually the property group, Oliver Hume, also put a press release out basically saying the same thing, that the 3% buffer was an emergency measure when interest rates were close to zero. But I guess at the moment it's overly cautious. It penalises first home buyers, and I guess it favours people with inherited wealth over people who are trying to buy a first home based on their income or two incomes. So we'll see how it plays out. But let's go through our three big news stories of the week. So this is our weekly 2 cent segment, and we just cover the 3 top property news stories each week. And then stick around, because at the end we'll do a few of your listener questions in the Q&A to wrap up as well. So first story of the week. Well, it's James Kirby at The Australian did an investor's guide to the election. So I've already forgotten when the election date is. Is it May the 3rd? I think it is, isn't it? So we've got effectively a 5-week election campaign that's already sort of run most of the first week. So we've got a month of leadership debates to stomach, with Kieran Gilbert hosting over the next month. So I guess when you look at the investor's guide to the election, particularly from a property market perspective, well, the ALP has already proposed expanding its Help to Buy scheme to higher price points and slightly higher income caps. And they'll probably be focusing on additional supply through the institutional space, so encouraging institutional landlords to build in the build to rent sector. The coalition has proposed use of superannuation for first home buyers, and also things like an excise cut for fuel, a 25% cut to immigration, and as you mentioned, a lending assessment buffer being cut to 2.5%. I was reading Leith Van Onselen in Macro Business, and he said, regardless of which party wins the upcoming federal election, a match will be lit under Aussie house prices, because basically both sides of politics are really focused on those demand side measures rather than fixing up the structural issues around supply. So I guess, what's your take on that? I suppose there was a few other bits and pieces in terms of policy. So I think the coalition would presumably be trying to cut the size of the public sector, and there'll be some of those public sector roles would go. But from a housing market point of view, it's like, well, both sides are kind of focused on the first home buyer and pushing more demand into the market.
Yeah, I think this goes into our first story, Pete. So maybe we crack on with that, and then we talk about because the Labor policy around Help to Buy. I mean, there's more clarity around that over the last couple of weeks as well. And but like you say, both of them are just encouraging more demand into the market by creating either more capacity or ability to buy because they're getting people more deposits, or basically having the government support them buying.
Well, yes, it does seem that way. I mean, I think there was nothing new in the federal budget that was specifically addressed at fixing the supply issue. I think just generally, assuming the Labour Party wins a second term, I think they're just going to rely on the cycle turning and supply picking up as it does cyclically anyway. But there was nothing particularly new on the supply side. So you've kind of got both sides jockeying for a position, particularly looking for those first home buyer votes. But I think, CoreLogic put out a report over the past week or two saying, well, when you actually look at historically, have elections made that much difference to the market cycle? Probably not as much as you might think. I think 2019 was a bit of an outlier because we had such different policies being taken to the election, whereas I think this time around, well, yes, there are differences, and particularly for things like superannuation, but for the property market, the policies, they're probably a bit more similar than different in a lot of ways. I think when CoreLogic ran through the numbers, I think unit prices that has increased a bit more when the Labour Party had won versus the coalition. And I suppose that, I don't know why that would be. Maybe I think first homeowners grants have been popular in some elections, and also maybe with the unions having so much power, maybe that's pushed up Labour costs when Labour win. But I think it's much of a muchness, really, and maybe the election makes less of a difference than investors tend to think.
Yeah, it's interesting. I think first home buyers, or younger generation, are becoming a more and more bigger force in election campaigns, right? More and more people are over the age of 18, are worried about housing affordability long term, and are looking for policies that suit them. Unfortunately, though, unless you're buying in the market right now, a lot of these policies aren't going to help you if you're going to buy 3-4 years down the line. So if you're active in the market, maybe this is going to give you a little bit of help. But those policies often very quickly get factored into prices. So you've got to be careful what you wish for when you're voting, because you might think it helps you, but if it pushes prices up more than what you think the benefit is, then you've just shot yourself in the foot. We've actually got the Senator as Assistant Treasurer, Senator on the elephant next week, and talking about their policies, the coalition's policies for housing, which is just crazy. I mean, why would you go to a podcast? It shows that that's so important for them to be out there talking to. And you also saw that with the budget, right? You saw all those influencers on budget night, which was interesting as well. So the younger generation, they're really wanting to get cut through there and try to win some votes.
I saw that. Yeah, a few of the well-known Instagram influencers were there in Canberra for election night. So, I think it's an interesting time. I think Labor has some contentious policies in the superannuation space, particularly if you've got a balance over 3 million. But maybe, at the moment, Labor Party are marginal favourites, but it could go either way. I think a lot of the global sort of trends are being driven by the US at the moment. And I think first time around, I think President Trump was very, very bullish for the stock market and bearish for the bond market. But it almost seems to be the other way around this time, with tariffs and then cuts to spending and all that kind of thing. So it's pushing down bond yields, but also the stock market's under a bit of pressure as well. So let's take a look at the second story this week. So the ABS every quarter puts out its household finance and wealth figures. Pretty interesting to see average household wealth in Australia per person, $618,000, so all-time high. And when you think about the 11 million or so households around the country, that equates to an average per household of over 1.5 million for the first time. So I think these numbers, people are always very quick to point out that a lot of the wealth is illiquid. A lot is tied up in either the housing market, but I think it also speaks to the success of the superannuation system in Australia because we've got sort of mandatory or compulsory contributions. But yeah, when I was looking at that aggregate wealth figure for Australia, it's just 17 trillion Aussie dollars. It's absolutely huge. And of course, there's a lot of disparity between the haves and the have-nots, and maybe that wealth gap is growing. But it's still, I think it's often an underestimated factor in Australia, just the sheer depth and the aggregate wealth that has accumulated, particularly since the turn of the century with the mining boom.
Yeah, and I mean, a lot of that is in housing, right? I think the property market's worth 11 trillion, 2 trillion of debt. So there's 9 trillion of the wealth. And you got your super system and the, shares, and then you got businesses on top of that, et cetera. So, you're right. When you add it all up, there's a lot of wealth in our system. I mean, housing wealth's an interesting one because if you haven't got enough money in super, you say, well, I'll just downsize. But often a lot of people can't find something they want to downsize to. And they go, oh, I want to move up the coast, but regional prices have been growing faster than capital cities. So that's not going to often release too much money. So unless you're going to go completely to the bush or move overseas, a lot of that money is really liquid and it's stuck in the housing system. And it just sort of that, because it's not moving around, people aren't sort of upgrading often now because of things like stamp duty. It's really just lazy equity, I would say, just tied up in a housing market. That money could be used way more productivity from a productivity point of view if we invested in businesses and, growing companies and, et cetera. But it's stuck in the housing market. But I also think that's the system that also supports housing market is that because it's getting more and more expensive, we have to sink all our resources back into housing because you've got to sell your shares. You've got to take a lot of money out of the business to support your home ownership dreams. And so we've sort of got ourselves stuck against the wall here because, there's just the success of growing property prices has some consequences.
It does. There's a disproportionate amount of time spent for people thinking about their property strategy, how downsizing might work and how it all fits together from an accommodation or shelter perspective. CoreLogic put out their monthly figures for up to 31st of March this week. Sydney prices were up 0.3%, Melbourne 0.5%. In fact, every capital city except for Hobart recorded an increase. So over the past year, capital cities up 2.8%, regional markets still up 5.3%. So when you actually look at the median value of housing, so that includes all dwellings, 900K now for the capital cities, and regional markets, which you once would have thought as a sort of a cheaper place to retire to or downsize to, well, 666,000 combined regional for the median value price. So nationally, 820,000 is the median housing value. So despite all of the debates about bubbles and crashes over the past 25 years, that is actually the highest nominal figure we've ever had. And it looks like Melbourne now turning around after falling 2.6% over the past year. So it's only really Hobart out of the capital cities, and Canberra's had a bit of a slow year. But generally, I suppose we've got a massive supply shortage. Interest rates are projected to come down 2 or 3 more times over the course of the next year or 15 months. And both sides of politics seem to be trying to push more first-home buyers into the market. So it's a big challenge. And as you said, the housing market valued overall at 11 trillion, but it doesn't look like it's going to change anytime soon. I just saw in the CoreLogic figures, Chris, as well, rental values also hit record highs, rising 0.6% in March. So over the past 5 years, rents have gone up 38.4%, more than double the 15.4% rise in wages. So I guess that just speaks to the general shortage of housing that's built up over the past 5 years.
Yeah, I'm not sure if you caught the Diary of CEO, Gary Stevenson and Dan Presley episode last week around inequality, and it was a bloody great content, and who knows how to produce it, Stephen Bartlett. But it was kind of like an insight, I believe, into the brewing problems that we've got here in Australia around people with money, right? They might leave the country if we start going too down the taxing route, but also the problems that the housing market in particular is causing with inequality and a societal problem with people not being able to get housing. They'll leave cities and they'll go to other places around the world and we'll get a brain drain. So I think it's a very good, because they're obviously got more acute problems in the US and say in the UK in particular they were talking about. So I think that's kind of a real insight to maybe what's coming down the line for Australia.
Oh, especially Europe. When you look at the level of government debt that's accumulated over, particularly since the financial crisis, and it's just been an ongoing issue through the pandemic. And yeah, I mean, you've already got 40% inheritance tax rates in the United Kingdom. And yeah, the push is to tax wealth more, and I think maybe once upon a time it might have worked, but now it's so fluid. I know so many entrepreneurs have moved to Dubai or Kuala Lumpur or other cities because wealth is so much more mobile now. So yeah, Australia can go down the route of increasing taxes on wealth, but it's a different world now. It's a global economy. And yeah, I mean, we're fortunate that even though we've got a decade of deficits ahead, government debt still is actually very low when you compare it as a ratio of GDP. Net debt to GDP of around, say, 30% versus when you look at what's going on in Europe, where in some cases it's over 100. It's a difference. We've got better problems here, although we still have problems. So third and final story this week before we go into the Q&A, population growth reverses to the capital cities. So I think, I mean, obviously during the pandemic, we had that big race for space, but it seems the capital cities are now attracting at least the bulk of population growth. So in FY23, the capital cities increased by 521,000. That's an all-time high. For the financial year 2024, the ABS reported the capital city population grew by 428,000. I think obviously the return to office is something of a driver, and some of those COVID refugees have returned to the city. I'd say, though, the population growth across regional Australia was still pretty strong. It was still at 1.3%. So it's not like it's gone away. But the biggest growth over the year, Melbourne, 142,600, Sydney, 107,500. But Brisbane and Perth still recording extremely fast population growth, 2.7% for Brisbane and 3.1% for Perth. So, yeah, I mean, I suppose because we've talked a bit about this before, I think obviously immigration is now the bulk of population growth again for Sydney and Melbourne. But internally, maybe still people are picking out some of those lifestyle regions.
Yeah, whenever we talk about populations as well, I think it's often people forget about just internal demographics that naturally in cities, there's more demand building because, the kid that's living at home and going to uni right now in 5 years' time is probably going to live in some share housing. So they need some rental accommodation. And maybe in 10 years' time, they want to buy something with them by themselves or with a partner, etc. And so, and then there's also people that are maybe 5 years older than that now that maybe wish they bought something, 5-10 yeyears ago and are in the rental market. And there's a lot of people in apartments that really want houses and are in, a basic, etc. So people moving back from overseas. And so, yeah, it's a really broad conversation. A lot of people think, oh, well, there's 100,000 people moving here, so we need to build, 50,000 new dwellings, let's call it. But there's also an undersupply problem that's been accruing for many years. And it's not just as simple as one for one that we need to supply.
Well, yeah. And it's, I mean, I think, it's becoming a political hot potato, and hence why the coalition has pledged to cut immigration by 25%. But I think the thing there is, though, you still got so much population growth is driven by temporary visa holders as well these days. So international students, people on other temporary visa classes. So yes, you can bring down the headline level of permanent migrants to Australia, but I mean, housing market is under pressure from a rental market point of view, but we still need skills and labour as well. So yeah, I think it's a challenge that's being grappled with. And I think housing supply will start to pick up. But I think a lot of the population growth seems to have been in the outer suburbs of capital cities, and often from people moving internally from other parts of Australia. So even though at the city level there's big growth in Sydney and Melbourne, it's often actually like in Sydney, Western Sydney, the southwest of the city, and so on.
Yeah, absolutely. Should we crack on with some questions, Pete? There's always a new element to our show that it's always a bit of fun each week.
Yeah, do so. Do send in your questions because anything topical we'd like to cover in the show. So I've got one question lined up for next week, but let's go through these three for today. And whatever we get asked next week, we'll cover. So question one from Mr. Schemer. So this one's a question for you, Chris, because it's a lending question. If you sell a property for which the loan is secured, is there any way to transfer the loan to another property, or does it always need to be paid back in full to the lender at settlement? I'm asking because I don't think I'd be approved for the same amount of lending now, given the current lending environment. Ideally, I'd want the funds sitting there quarantined, waiting to be allocated to another property. I think I know the answer, but I'll let you cover it.
Look, I think the issue is you've got responsible lending rules, right? And so when there's a major change to your loan, i.e. switching security, a bank's going to say, hang on a sec, let me just do an assessment on your lending situation to make sure you can afford that loan, right? That's just their obligation as a lender. Sometimes you can make minor changes. It might be going from principal and interest to interest only. But even those were under watch just a few years ago, back in Royal Commission days, where the banks were very scared of making, anything that would, put them at risk as, basically failing responsible lending guidelines. And so that's probably the answer here. However, if you could get lending, sometimes clients will do this, right? They will structure their loan so even though that debt is for a different property, they'll put that debt on, say, their home, and then when they sell that investment property one day, they can get themselves all the cash for it, and maybe gives them a bit more buffer. Rather than when they sell that property, that debt has to go, for example, and maybe they can't refinance at that point in time. Maybe it's a business or etc. So you do need a bit of a debt strategy here. You can absolutely move your debt around. That's your choice, really. Banks don't really care. The debt that you've got for a property has to be secured by that property, but you need to have some equity on other properties to transfer it to. You can, when there's times when you sell a property and you've got a debt attached to a property that you really want to keep that debt limit there available. Let's say you used equity in one property to buy another property, and you're selling the first property that has equity secured against it that's for another investment property. So if you sell that property, you basically reduce your tax deductible debt. So often in these situations, which we've done for lots of clients, you have to do something called a substitution loan, and sometimes you have to use term deposits, and some lenders will do it, some lenders won't. And so this is where a good loan strategist will look at your situation, consider what options you've got. You might be surprised. I mean, at the moment, you probably hit the nail on the head. If you have leveraged up in 22, 23, or your work prospects aren't as positive as they were just a few years ago, lending's probably tough. But you might be surprised. There might be some non-banks out there that you might be able to consider that have got lower assessment rates that you can get the lending you need. And sometimes there's reasons why you would pay that additional interest. So it's a good question.
Yeah, fair enough. So great. Thanks for that one, Chris. All right, question 2 from Daniel. So the big drivers of property prices over the last 20 years have been interest rates in dual income houses, less so population growth. What annual return do you think can be achieved over the next 20 years in metro markets? So a bit of a crystal ball thing here. I might just back up the truck a little bit. I mean, when you're looking at property prices, you've really got two components. You've got the land value, and we often say in our podcast, you really want to get assets with a high land value component because that's the scarce commodity that's doing heavy lifting for you. Then you've got the building value, and cost of construction certainly gone up a lot over the last 5 years. I think I actually did some sort of casual research a while back, looking at some blocks of land sold in Narrabeen in Sydney in 1922. So 103 years ago. And you can put down a £2 deposit, and I guess we've since transitioned to Aussie dollars. But those blocks today would be north of $2 million. So that's 11.5% compounding annual return for 103 years. So I would say, yeah, if you've got the right block of land, there's certainly the dynamics are there, scarce commodity, landlocked areas to get strong long-term growth. I suppose the flip side of the argument, Robert Shiller wrote in his book, Irrational Exuberance. And if you took home prices in the US going back to 1890, housing prices shouldn't really sort of appreciate more than the rate of inflation. Of course, then we got the property crash in the US with the subprime bubble, which bottomed out in 2012. And everyone was like, well, that proves that real estate's a bad investment. But I would say there's two things there. Since 2012, housing prices have gone absolutely nuts in the US. So that doesn't really support the thesis that Sheila had. But also, I think there's another thing, and that's that, residential prices in the US, that incorporates Manhattan and then some farms in the Midwest that have become worthless, So I think, yes, there's a macro question and a micro. I guess I was asked this question when I wrote for a Property Observer in 2011, and I said, probably going forward, housing prices in metro markets will be more closely tied to the growth in household incomes. And plus, we've got a 2.5% inflation target now, or 2 to 3%. So I would say, yes, 2 to 3% inflation. Plus, though, if you're investing in scarce commodities, scarce blocks of land in landlocked areas, you'll probably find that you can do better than the rate of inflation. And actually, people have found that has been the case over the past 14 years. So I would say, looking forward over the next 20, yeah, if you pick a dud asset, you might get the rate of inflation if you're lucky. But if you pick well, you could probably do a bit better than that.
Oh, it's a good question, Daniel. And I think you're right. Like, I think that borrowing capacity, the access to credit being, but that's kind of come down a lot since 2014. So, borrowing capacity is way tighter than it was, say, 10 years ago. So you would think that, prices would be fallen, but prices are way up on 2014, for example. Wage growth is not equal, right? Some areas do have faster wage growth, whether it's, the double incomes versus maybe 1 and 1.5 incomes, or 2 higher incomes. 2 higher incomes are buying in a suburb versus 2 medium and lower incomes. So wage growth can happen at a individual level, can happen at a family level, can happen at a suburb level, can be different. I think that you're right that, you say in the 80s, there was 1 person working and there's 2 people working. So you're not going to go from 2 people to 3 people working, but we might see some multi-generation homes. You might see families buying together. There's, innovation with banks. Who knows? Like, there could be reverse mortgages. So there's going to be lots of things that drive prices long-term that you just don't think are going to drive, because just the system that we're built, I would say. Now, do you need to be growing, doubling every 7 to 10 years and all that bollocks? Probably not, because to still get a decent return, particularly if it's on a home growing tax-free over your lifetime, it doesn't need to be anywhere near that to still be a very good bet versus renting, right? So even if you put a small, a 3 or a 4% return on it, you might find that it still really works. And if it gets 5, 6, 7% compounding return or more, well, great. But I think, I think just buying property and it just growing at a crazy rate over the next 20, 30, 40 years, it might not have those same sort of tailwinds that it had before. However, I also think the population growth has had a big impact on it. I think while you might think that more people does also drive demand, it drives our economy. And as more people as a percentage of that population can afford housing, the money doesn't evenly split across our economy, and the people in the sort of medium and high rings go compete over scarce assets that we're not selling. So I think that, and then also cause a rental crisis, and that if it's easy to rent, then people aren't forced to buy. But if it's, fast growing population, which is what COVID's proven over the last few years, even in the face of high interest rates, because our population's been growing and it's really hard to rent and buy, then people are forced to buy. So that would be my take, Daniel.
I think the other potential X factor is just falling home ownership rates. We've got a high rate of home ownership in Australia, but it has generally been trending lower since the highs. And that could easily happen because, 30% of the population was born overseas. And if you include people with foreign-born parents, it's over half the country. So I could easily see an environment where the home ownership rates fall to 60% and maybe lower. And that's why it's such a contentious issue in the upcoming election. So last question for this week from Billy. Serviceability. I've just started my own business. How can I improve it? Earn more money, I suppose. It's the simple answer. But are there any special tips, Chris, for somebody who's just starting out? Because it's always hard in that first year or two because you haven't lodged new accounts and so on. But any special advice?
Look, banks have relaxed lending to employed borrowers a little bit. So if he pays off a salary, Really need to know when your ABN was set up. So if you are thinking about starting a business, get on top of it and get your ABN set up early, I would say, even if you're not trading. Because a lot of banks will just look at when you started that ABN. A lot of banks want to look at all 12 months financials as well. So, if for example, it's April now, you might sort of try to run a lot of expenses through before 30 June. And then you might so next year you're sort of ahead of the game. And, so next year could be a good year income-wise. You might try to, really work flat out for 12 months to get a really good year of servicing. A lot of banks will just look at the last 12 months rather than the last 2 years. That's been a bit of a shift over the last 12 months. We've gone back to how it probably was pre-COVID. A lot of lenders will just base it on the last 12 months. And so, it's just been really understanding of your situation and, is the benefits of just paying yourself a salary. A lot of banks will just lend on you getting a salary for 6 months, which never really existed before. But self-employed lending is quite complex, and you do need to have a strategy around it. So this is where a good broker that understands that world will be able to guide you and say, okay, well, we're not going to use these lenders because that's not going to look at your situation great, but we potentially could go here. And maybe there's also load off loans, and so maybe it's a risk for some people, but some people you might be worthwhile considering just to enter now. It might pay a higher interest rate. And then in 12, 24 months, you're really confident that you're going to be able to get out of these loans and get yourself into a mainstream lender and get yourself on a lower rate. And so paying a higher interest rate for 1 year while you're, just getting that good year of financial is sometimes worthwhile.
That's right, because if you go to the low doc route, you could be paying 8 or 9% on your mortgage, and it's a lot. So let's finish it up there for this week. So do send us your questions for next week. It's always good to cover a few in the Q&A, and it's good to be across what's topical and what's hot and what's not. So thanks for joining. What's on for the weekend, Chris?
Just up to Newcastle. Spent a bit of time with my mum up there, and like I said, I might do some go-karting, catch up with my best mate up there, and go down Merrill with the beach. Can't knock that beach.
I was going to say break a leg, but don't do that. And it's we're going to see the Broncos this week, so good start to the season in the NRL. So fingers crossed for a win at Suncorp. And if you want to join us on the Rask Community Forum, it's community.rask.com.au. Not just property, shares, small business, and everything else you want to know about finance on there. So thanks, Chris. Have a cracking weekend, and thanks everyone for joining. We'll see you next week.
Good to chat. Have a good weekend, Pete.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.